So Cineworld was saved from bankruptcy with access now to over $1 billion. That should keep them going for at least the short term. Their future is still in question. However, one thing that isn't is their stock price, which has went from about 2.4 pence, yes, pence, back on Monday of the 31st of October to, it actually hit nearly 9 pence there. Now, for all you, that's nearly a 300% increase. That is, for losses, that's not unusual in certain cases, but for gains, I haven't seen anything like that in quite some time with such a major company. Now, you can see it was not but a year ago that Cineworld was at 64 pence. Heck, you could go further back. It was trading in January of 2017, or June of 2017, nearly £7. So, to put that in perspective, 2 pence per share, £7 per share, that is a loss of magnitude. Now, I obviously cover dividends in this channel. Dividend investing, my favourite kind of investing, is obviously the forefront of this channel. But what if I told you, I actually do invest in other things, and I have my own strategies, my own thought processes, and none of this is financial advice. We're going to delve into that today and see what all has been happening. Now, a lot of you that are familiar with the portfolio videos, I know you all are. It's up about £200. I bought some more Artel Africa, which is still down. But Cineworld doesn't sit in any portfolio. Now, I have 3 types of investments in this. One is my dividend portfolio. You all see it. The other 2 you haven't seen yet. But the second one is growth dividend, like growth investing, where you buy low, you sell high. Now, it's such a glass cannon. Things can go horribly wrong. And I'll tell you what made me decide to throw in I think I invested about £550 into Cineworld stock. Not all at once, just it was a wee trickle. So when it was announced that it was going down the tubes about 3 months ago, I bought in at about 4 pence. So about here. It was about August the 18th that I decided to pull the plug, and I bought some Cineworld stock because I thought, whoa, that's the lowest it's ever been. Now, that's terrible foresight. It's like, oh, it's low, so you should get it. It could keep dropping. Now, I made the calculated risk because I went on Simply Wall Street. I had a look at their financials. I had a look at the situation. I had a look at so many things. Now, what really took me to Cineworld is that they recently opened up a brand new one, the Odyssey, down in Belfast. And I went after COVID. Everything was opening up. I was utterly impressed by the service, the quality. It was brilliant. A lot of people say cinema's down. A lot of people saying that it'll never recover. There's a lot of pessimism around it. But for me, I was impressed with the business, the way it was run, and, that is just one cinema. It's a small footprint. I think they've over 9,000, or is it 9,000 employees or 9,000? But we'll see it in the next screen. We can actually pull it up here. 9,000 screens of 790 cinemas across 10 countries. Bulgaria, Czech Republic, Hungary, Ireland, Israel, Poland, Romania, UK, and the United States. Now, Cineworld, for a lot of you, I won't give a super massive history lesson on why their stock price is completely collapsed, but what I can tell you is they were trying to acquire a competitor over in Canada. It fell through, they had to pay money, and that was just before COVID. Now, I think they were running off because they were a cash flow monster. They were generating serious cash flow. They didn't have not an awful lot of debt. They had a lot of equity that they could use against debt, and what they did was try to finance a few acquisitions, trying to become the biggest cinema chain in the world. And they were pretty much marching their way in that direction. And to be honest, if the pandemic didn't hit, there is a high chance that strategy would have worked and would have went well. They were dividend payers. So, they paid dividends between 2014 to 2019 at least. The yield varied a bit, but they obviously stopped into COVID. They stopped paying the dividends. So they were dividend payers. So technically this stock belongs on the channel perfectly. And as you can see, since I've been talking to you, it was down about 900. Now it's up to 1,200. I started off today at £5,708 in my ISA in total, and I reached an all-time high there of nearly 5,000, nearly 6,000, which the jump from the loss was meteoric. I'm only £1 down in my in my UK dividend portfolio. It'll probably rise. And then of Cineworld, and it's up nearly £600. Now, there is a third section of investments that are not visible on this, and I'm keeping that for a later down the line. They'll take a lot of talking about, and my thought process on it and all. In the meantime, it's dividends and Cineworld, and Cineworld has just boom. This is real time. I'm getting this video out as soon as I can, just to show you it's massive. The jump is massive. So dividend growth investing, you buy a stock low, you sell it high, or I suppose wouldn't say it's so much growth as in just buy low, sell high. Very, very simple. It's probably the first concept most people know when they go into the stock market. You buy low and sell high. Buy for £1, you sell for £2, profit. Because it's in the ISA, tax-free. If I sell it all, it's tax-free. That's a brilliant thing about an ISA. There's probably a wee bit more to that. I'm not a financial advisor, so take that with a grain of salt. I'm not selling out at the moment because, as I said, I bought it in at about 4 pence. Then I bought in at about 2.7 pence. Now, the thought process there, ideally I should have got in at 2p. It was at 2p, between 2 and 3p, and I should have. And I did kind of invest towards it, but there is risk. Listen, see when you place your money into anything, it's a lot of emotions. It's emotionally driven. It's in the red. Oh dear. I've got to sell, or it's in the green. I'll sell now. And both those people can end up having regrets. The one that sold in the red, it maybe went to the moon. Some people that sold in the green right now in a year's time could have sold for 10 times, 100 times. There is so many factors in doing these types of things, and there's risks. Like, at the end of the day, I have to accept that investing has to be an emotional sport. It's not a sport, but you don't bring emotions into it anyway. Because if you get really emotional and you're checking your portfolio and you do everything, it can really consume you, and you can make really rash decisions. My thought process was pretty clear cut. I thought, well, this company, big company, I was impressed going into their facility. Trust me, see if I had went and I wasn't impressed and I thought it was just a dingy cinema. Some of them might be. I'm not going to comment on all facilities. But my assumption was they are where they are for a reason. There was really intelligent people running this company. The reason they were gunning for an acquisition is clearly they were in, the massive cash flow generation. They paid a dividend as well. Their past history doesn't look, horrible. They had an all-time high near £7. Things were going fantastic for them. But they've obviously fallen in hard times. COVID is the main driver for these problems. It's not the only factor. There's many more for Cineworld. But COVID has punched the cinema world in the entire one, across the entire industry, in the gut. Now, some of them are surviving, some of them are, just barely getting by. Some haven't made it, and some local ones have just completely closed. I know of that. But I looked at their financials, which is why we're going to pop on over to Simply Wall Street. For anyone that doesn't know Cineworld, you can just pop in here. They show movies. They're a cinema. I don't feel I have to explain that, but it is what it is. Avatar's actually coming out soon, and there is lots of really, really popular good movies. There's Bad Santa, a lot of the Halloween ones. They've been throwing certain events, and I think even in the start of next year, Black Adam's out as well. There's a lot of films coming, and the problem for the cinema industry is there wasn't any good films over the summer. There was very little. There was no blockbuster ones. Marvel's got a plethora of them coming out soon as well into the next couple of years. And the cinemas rely on these big ticket items, big movies that get you in to spend mega bucks. That's where they make a good bulk of their money, is from these big, massive releases. So the thought was, movies are picking up. The stock is basically at an all-time low that you probably never see again. Again, you don't know. So I cost into it. I think I put about £300 in the first time, and then £250 at the lower, and it gave me a sort of 3.8 pence average. Right. So did that, and then this morning it was about £2.40 on opening. Next thing, my price alert went off at about 4 pence, because I had a price alert way back when, and it was like, oh, it's now 4 pence. I was like, what? Then I read the news. Cineworld surges after bankruptcy settlement. It's like they soar 111%. Regal owner, that's some other problem from 6 days ago. It was basically they got funding, things are looking up, and the stock just absolutely rocketed. And in fact, when I started making this video, it nearly breached 9 pence, which that's nearly tripling in a bit in one day. Now, what the stock price might do is anyone's guess. As you can see, it's now sort of breached August levels, just sort of mid-August of this year. Now, where they were trading on average was about 23-25 pence in that region, pre-August, July, June, May, when it was trickling down. Year to date, it was at a high of about 43 pence. Now, what does that mean for my investment? Say it was to recover to 20 pence. I have 16,000 shares, as you can see, loaded up right here. Investment, 16,000. If it was to jump to that would be an increase from 2 pence. That's times 10, essentially. That's almost, that would be nearly 5.5 grand if it reached that stage. That's crazy. Would I sell at that stage? I'd have to, what is the price? That's a lot of things for investors. What's the price you would sell at? Well, to be honest, I'm already 63% up and like £400 up, and it's fluctuating all day, and who knows what it'll close at today. Will I sell and put it in dividend funds, or will I hold on to it? To be honest, I personally am going to hold on to it. I'm going to see how it goes. It might dip back down to 5p and trickle along, but I want to see how Cineworld does when a lot of these new movies in the coming month up to half a year. I want to see how the stock progresses. I'm not in a mad rush to pull it out, and to be honest, I think a bit of calm. There's been an adrenaline rush today of seeing my portfolio go from minus 681 to nearly positive 300. Like, that's £1,000 up. That's closing in what most people making near a month, myself including. It's like, whoa. You have to take a sort of deep breath and analyze the situation, see where we're going to go from here. Going over to Simply Wall Street, it can give you just a wee bit more insight into how I was picking that up. It's trading 99.3% below its fair value. To give you a bit of an idea where we're sitting at right now, is their pay-E ratio, like earnings of 2.6 billion and a market cap of 32 million, which is pretty crazy. Obviously, 344 in the red. They had the audit. Things weren't looking good. But in valuation, let's have a wee look here. On their sort of £3.21's their fair value on a discounted cash flow model, they're 2 pence. If they were at £3.21, I would have 48 grand, 50k. That is a pipe dream. That may never happen now if you hold it on maybe for years upon years, but things could happen. See, that's a problem with this kind of investing. It's very high risk, high reward. At the end of the day, they could have actually just completely collapsed. Now, they might have chopped off a few things, maybe their US side of the company. They could have done this. There may be loads of options. I'm not in the boardroom. I don't know where. I'm neither in financials. What on earth you do at that stage for this big a company? But I wanted their financial health, and I was like, okay, right, well, assets to liabilities in the short term, but long term, they have a lot of assets. Now, you can see here, obviously in the run-up to sort of 2017, they were positive debt-to-equity ratio and had a good bit of cash on hand. Then they were obviously trying to use that here for a lot of acquisitions and, major growth. And now we're looking at, that's not great. But look at the cash and equivalents, 436 million. Even today, 136 million. They still generate good bits of cash flow. It's a cinema. You think about it. You go in, you buy a ticket, you buy popcorn, you buy a drink, you spend a good bit of dough, and obviously that all adds into cash flow, and that's fantastic. Now, let's see the wee dividend. If they were paying what they paid previously, it would be sitting at 552% yield. That's crazy. You can see their dividend per share was even growing up to 2018, and then they receded until COVID hit, and they ended up. They had a 12% yield in 2019. Do you know, there is a possibility if I hold on now, analysts are somehow forecasting they're going to magically start paying a dividend at 10 pence. Well, news for you, 418% yield. I don't think the dividend will be reinstated anytime soon. I think that they would need a year or two to sort of sort themselves out, even if they have a lot of things that would need to go very, very right for them. Cinema numbers would need to pick up the near pre-COVID levels, maybe even better. Then they would need many, many massive, great releases, you know, from Marvel, DC, major cinema or studios. And economically, things would need to be better, because I can assure you that a lot of people in the current economic climate are not going to consider the cinema as the first go-to, considering the price. I'd imagine it's an industry that does really well in good times. You know, maybe not so much when people are going to, you know, if people cut their Netflix, they're also going to cut their, you know, going out to the cinema at the weekend. All things to consider. And it did. And I'm happy that I pulled the plug on it, of course. You know, I'm happy with it, but I felt it would make a good video to at least explain that, you know, there is loads of investing strategies. There is this one, there's buy low, sell high. I don't specialize in it. I've done it maybe 2 or 3 times in my life. Ironically, the other 2 or 3 times went really, really well, you know, and some of them were extremely high risk. Back in school, I remember I invested in, gosh, their name eludes me. It shows you how little I knew what I was doing, which is actually borderline gambling, dangerous levels of stuff. I put about £200, which at the time was more than I ever should have put into something. And I think the company got bought over. Its stock was quite low. It got bought over. And I sold at £430. I thought I was king. And I still didn't really get to learn into the stock market. I was very basic levels. I read a few books at a basic understanding and did that when I was 18. And to be honest, I should actually look up the name of the company, because I can find it in my emails using the Share Center or something. That's what I was using at the time, because Trading 212 I don't think was about. But yeah, they went well. I did it a second time and it also went extremely well. And that's actually the third investment that is sitting in this portfolio that you cannot see. Someday I will chat about those investments, but at the moment, concentrating on dividends. And at least now you've seen the Cineworld Group. To be honest, at one stage I wasn't even considering speaking about this stock. But this is a fantastic opportunity to sort of lay it out and give you a bit of an idea. I would love to hear your opinion on this kind of investing. I know a lot of you dividend growth investing is seen as a relatively, you know, safe, you know, stock market. Nothing's insanely safe. There's safer and riskier options of doing things. But for me personally, I love dividend investing. I love long term. I love looking, and you know, it gives you a good idea. And when you invest with no emotions, you can pick up some bargains here and there. And you know, it's very important when you invest with emotions. I could have sold there at 288. I'd have been up, you know, I'd have near doubled my money. Sold out, couple of weeks' wages basically paid for, and I could have threw about 1,500 then into the investing account. And that would have probably led to, you know, an increase of maybe like 30, 40 pound in the investing account, you know, for the portfolio. I could have done that, but I didn't, because I'm going to hold on to it and see how this runs, because I'm very happy at the returns at the moment. And I think there is a good, you know, I'm not holding for the long term. This isn't like in 20 years I'm going to sell. I want to see in the next 6 months how it goes. But at the moment, I've at least made my money back, and a lot of investors, you know, sometimes can't even say that. It was a risk, honestly. The more I think about it, I was going to sell a few weeks ago at about, you know, I think it was down to £484. I was going to just sell out and say, well, you know, I'll use the money and stuff. But I held on. I went, no. I made a good conscious decision in my own head as to why I wanted to do it, you know, because I looked at the financials, the future, took a few things into account and just made I'll go for it. Now, why didn't I dump everything? Because that would have been completely irresponsible. I could have took £3,245, dumped it all into that, and you'd be like, oh, well, you'd have doubled your money. You'd be sitting near like nearly 10 grand right now. Yeah, hindsight's brilliant, isn't it? If only we knew what was going to happen, it would make a lot of investing decisions so easy. But yes, let me know, does anyone watching, did you have Cineworld stocks? You know, What do you think of the situation? You know, would you have held? Would you have sold? That's a brilliant question. If you were in my position, what do you think you would have ended up doing? Would it have been nope, gone? I suppose that all depends on your own situation and what's going on. If you needed the money, it'd be sold now, and if you didn't need the money, a lot of people would be well then just hold it. But anyway, that's been nearly like a 20-minute rant. I am going on to do a dividend video. We're going to revisit Burberry and then go on to Segro and a few other REITs this week. So plenty to look forward to. Thank you for joining me, and I'll see you all in the next one. Bye-bye.